Okay, I promise some pleasure with this pain. So again, I'm Charlie Eaton from UC Berkeley. And I think a lot of you probably know the story of cuts at UC pretty well. You probably know pretty well that tuition has tripled over the last 10 years from $4,000 and change a year to over $12,000 and change a year. We've had cuts in enrollment of qualified Californians. Our classrooms are overfilling, and as we just heard from Strike Debt, students are taking on increasing amounts of debt. But what's a little bit less known is that UC as an institution has doubled its own debt in just the last 4 years. I don't know how this thing works. Okay, that's me. And I promise after this presentation you will want to follow me on Facebook and Twitter. So you should just go ahead and do that right now. As I said, UC's debt doubled in just 4 years. This is UC's debt since 2007 went from $6.9 billion to over $14 billion. And what has happened is that in addition to the cuts, because of the debt service costs associated with this doubling of debt at UC, students have taken yet another hit, and potential students who can't get into UC because of money going to pay debt service costs instead of paying for UC's core mission. So we're kind of on the front end of research about why this is happening. We put out a report called Swapping Our Future back in November. It got some attention. There's a bunch of copies over there that everybody can grab after this, because I know you'll want your own copy. But the basic hypothesis for why this happened is that this is a sort of financial colonization. And what I mean by that is that what's happened at UC and many other universities is that Wall Street has gone casting around looking for new markets to make money off of, and new markets to sell financial services to, new markets to invest in. And those new markets have come even to include social programs and social policy. And what has happened, to follow Naomi Klein's thesis of disaster capitalism, is that when there's a financial crisis or revenue crisis at an organization, that's the prime time for a Wall Street institution to come in and say, we've got a solution to sell you to your revenue shortfall problem. And that solution involves us issuing more bond debt for you, engaging in derivative contracts with you, selling you additional financial services. But those things come with a cost. In Jerry Brown's words, the trade-off is universities need to show that they're not going to invest the capital from those financial services and from that bond debt in core mission programs and expanding access and keeping tuition down. Rather, they need to show that they're going to invest that capital in things that will bring significant returns. And one of the things that Jerry Brown points out is that's been an investment in what's called the amenities arms race in colleges. If you go to a UC campus, you'll see the fancy new dormitories that have been built. You'll see the fancy new stadium at UC Berkeley, which now notoriously, we were told it would turn a quick profit, but in fact it's losing tons of money because they can't sell a bunch of the seats for the stadium, and so students are going to have to pick up the costs of not having enough revenue to pay off the revenue bonds. And what UC does every time it takes out this debt is, in order to get the best rate, they say, well, we promise if the revenue project, whether it's a dormitory or a dining hall or a medical center or a stadium, if it doesn't return the revenues we expect and that you on Wall Street expect, we can always raise tuition. And if politics makes it difficult to raise tuition, we can always limit enrollment for students from California so that we've got more space for students outside of California that can pay higher tuition rates. So a little bit more of this story. This isn't that interesting. So a little bit about how they do this, how they've expanded their debt. Like other parts of the economy, they've used fancy derivatives and financial instruments that haven't delivered what promise it. And the big one that we documented in this report that got a lot of attention in the media is called the interest rate swap. And basically what an interest rate swap is it's a contract that's associated with bond debt. And so what happens is I'm UC, I'm going to take out a bond, and I'm going to go to a bank, perhaps the same bank that's the broker for the bond that I'm selling on the bond market, and I'm going to make a contract with them. And in UC's case, they said, okay, we're going to pay, one of our interest rate swaps is with the now deceased Lehman Brothers Bank, which then got transferred to Deutsche Bank, which some of you might know has been found complicit in LIBOR manipulation and interest rate fraud. But so we say, all right, we're going to pay you $750,000 fixed payment a month. And in exchange, you're going to pay us a floating rate. And that floating rate will depend on where the bond markets are at, what the interest rate is on the bond market. And it's basically like UC would say it's an insurance policy. In a way, it's also a bet. And so UC has lost so far $50 million on this bet, and stands to lose $200 million on this bet because with the economy crashing, with LIBOR manipulation, the rate paid to us by banks on the interest rate swap is so low that we're losing huge amounts of money. And the question is, if that's the only way, making this bet that we lost, if that was the only way to borrow all of this money, should we have borrowed the money in the first place at all? So if the question is that, well, why did we borrow the money in the first place at all? And why are we continuing to maintain these contracts? Now, I think this is Supervisor John Avalos, is that right? So a round of applause for San Francisco Supervisor John Avalos. So I bet that Supervisor John was around when the San Francisco Asian Art Museum ran into trouble with one of these interest rate swaps. And what the city of San Francisco did as a financial sponsor of the Asian Art Museum was they said, you know, this interest rate swap was kind of a scam, and you sold it to us on a fraudulent basis, and we can't pay it off, so we want to renegotiate this swap. And they got the bank to say, okay, we're going to eliminate the swap agreement. You're off the hook for these swap contract payments. And it saved, I believe, about $10 million. Now, the folks at UC haven't done that. Also, the folks at Harvard University and Vanderbilt haven't done it either, even though at Harvard they lost $1 billion on these interest rate swaps. So why wouldn't UC try to renegotiate? Well, part of the story is people like Monica Lozano. Monica Lozano, as you see here, is one of the proprietors of the La Opinión newspaper in Los Angeles. She's also a UC regent. She's also, at the same time that she's been a UC regent, has been on the board of Bank of America, one of UC's major creditors. This is Russell Gould. He comes from Wachovia Bank after he was he was a CEO at Wachovia Bank and then became a Wells Fargo vice president when Wachovia went bankrupt. Also a UC regent during this period. So guys like Russell and women like Monica went out and said, hey, we've got this other former regent, Peter Taylor, and Peter was the West Coast Public Finance Division director for Lehman Brothers at the same time that he was a regent. And they went to him and they said, hey, we want to do all this borrowing, And he probably at some point went to them and said, hey, I got an idea, we could lend you all this money. And with the same bank that one of our regents was from, we went ahead and executed this interest rate swap agreement. Peter Taylor was then hired by Lozano and Gould as UC's CFO beginning in 2009, and so he is the same person that maintains the interest rate swap, even though he comes from the bank that sold it to us and comes from the division that's responsible for public finance clients like the University of California. Likewise, Nathan Brostrom used to be the managing director for public finance at JP Morgan, 1996 to 2006, at a time when JP Morgan sold UC an interest rate swap. He then got hired as the executive vice president for business operations. So these are the folks who have been executing this. Again, I told you you would want to follow me on Facebook and Twitter, so if you haven't yet, please do. And I'll close on this. So these kinds of crises happen throughout the economy. They've happened. We've had these kinds of revenue crises in California with our business cycles. There's obviously a revenue side solution to that where we can diversify the kind of taxes that we have. We can increase taxes on the very wealthy, as we have done recently, to increase revenue so that we don't have cuts to the University of California and we truly fund it as a public institution. But you're still going to have a business cycle. You're still going to have ups and downs in revenue. And there need to be alternatives to turning to Wall Street and alternatives to the sham solutions like more borrowing and more interest rate swaps, more derivatives, more risky financial services, where you've got to turn a profit instead of fulfill your core mission. And public banking, to me, is obviously could be at the core of an alternative to that, where we're providing capital during the right points in the business cycle to organizations like UC that are at the core of our economy, that have a key public mission. And so I'm proud to be a supporter of public banking and really happy to be part of this conference. And thank you so much for your attention.